Hi, I'm Pattu from FreeFinCal, and that's right. Your EMI is actually kind of an SIP for the bank. There is a lot of similarity between the mathematics associated with calculating loans or EMIs and interest payments and so on, and the mathematics associated with investing. That is the to find out what is the SIP amount needed to achieve a certain goal or create a certain corpus for a given return for a given number of years and so on. In fact, the loan, the ideas behind loan and interest are essentially identical to the ideas behind investing and returns, and that is what I want to illustrate with an example. So, how the EMI that you pay is actually an SIP investment for the bank. Couple of years ago, maybe a year ago or so, even now it's going on. Franklin had a campaign saying that SIP, a mutual fund SIP, is like a good EMI. This video has got nothing to do with it. I'm not here to talk about how good an SIP is or how bad an SIP is or how good or bad a EMI is. This is about how these two ideas are related. So let us say that you want to take a 10 lakh loan from a bank at 10% interest rate, and let us say you want it for 30 years, just as an imaginary situation. Of course, it doesn't make sense to take it for that long a period, but let's take it as an example. So the bank will think, instead of giving the 10 lakh to you, obviously the bank has the 10 lakh, right? Instead of giving that money to you, if the bank had invested that 10 lakh at the rate of at an annualized return of 10% over 30 years, not 10% a year, but an annualized return of 10% over 30 years, it would have got, if you use the standard compounding formula, it would have got about 198 lakhs. So it has 10 lakh, the bank has 10 lakh with it. It could give you the 10 lakh because you want it at a 10% interest rate. It will think, if I do not give you that 10 lakh loan, and if I invest that, if the bank invests that money over 30 years for an annualized return of 10%, after 30 years it would get about 198 lakhs. So the bank will think, since if I invest it, I will get 198 lakhs, I must get that amount from you by giving you the 10 lakh, and I must collect that 198 lakhs over 30 years, payable each month as a equated monthly installment, which is the EMI. That's the logic with which the bank operates. Now the bank will ask, what amount should be invested each month, so that if I assume an annualized return of 10%, after 30 years, the investment value will be 198 lakhs. This is like asking, I need 198 lakhs after 30 years. I am assuming an annualized return of, or a CAGR of compounded annualized growth rate of 10% or XIRR, if you want to call it. What should be my monthly investment so that I achieve 198 lakhs at an annualized return of 10% over 30 years? This is how a financial goal calculation works. This is essentially the same as a SIP calculation. What is the amount that I should invest? And this SIP math is given by this equation. Don't worry about this. I don't want to explain the math in the video. Please click the link in the description box. The formula are explained there. You can actually understand how it is calculated. So the bank actually calculates how much should be invested each month to get that 198 lakhs, and that SIP amount or the monthly investment amount is essentially 8,776 approximately. So the bank will say, I will give you the 10 lakh, you will give me every month over 30 years 8,776, which is essentially an effective interest rate of 10%. Therefore, the EMI that you will pay every month will become an SIP for the bank. I hope you understand how it works, right? They are calculating it just like the way they would calculate as an SIP. First they ask, I have the 10 lakh. If I give you the 10 lakh, you will give me an EMI. But if I don't give the 10 lakh, if I invest the 10 lakh, after 30 years for an annualized return, I will get 198 lakhs. What is the monthly investment I should make to get the same 198 lakhs after 30 years at the same annualized return of 10%? And that is just an SIP calculation, and that SIP is 8,776. And the bank will say, that is your EMI. I will give you the 10 lakhs, you pay back over 30 years at an interest rate of 10%, and you pay every month 8,776. And that is how your EMI becomes their SIP. And that is how the two formulae, or the two math, the SIP mathematics or the investment mathematics and the EMI mathematics or the loan mathematics are essentially identical. And this is what I wanted to say from this video. So I'll catch you again in another video. If you do not understand how this concept works, you can click the description box to get an idea. Otherwise, leave a comment and I'll explain. So I'll catch you again later. Bye.